Welcome everyone to another episode of How to Make Money in Stocks with Investors Business Daily. Now, Amy, you're going to be on the road again this weekend, so we're recording some of this a little bit earlier in the week.
Yeah, so February 23rd, I'm going to be with Larry Elder at the Westin in Pasadena for the Wealth Summit. Come out and join us. February 27th, I'm going to be in Houston for a Leaderboard Summit. And then March the 5th, I will be in Orlando, Florida for a Level 2 workshop. And I'm racking up those frequent flyer points, Matt.
There you go. And you can get all the details on those events on our website, investors.com/investing show. Now, this week, we're going to talk about a technique you can use to see if a former leader that is now kind of beaten down, you can see if it's getting ready to potentially make another big run.
But first, Matt is going to take a look at the market.
The market flashed a positive signal this week that may mean it's ready to climb higher. Now, earlier this month, the NASDAQ undercut the intraday low that it hit during the August 2015 flash crash. Although the daily swings were fairly wide, notice how the closes for these 4 days in February were fairly tight as it tried to establish a new bottom. It then jumped higher for 2 sessions this week and flashed a follow-through day on Wednesday. Volume was higher than on the previous day, and that switched the outlook to confirmed uptrend. The NASDAQ gave back a little bit on Thursday, which is not unexpected. Then it moved higher again on Friday. The new outlook may mean better times are ahead, but as Paul Whitfield noted in Thursday's Big Picture, the difficulty now is twofold. Quality breakouts are scarce so far, and the IBD 50 has a defensive composition. Now, also keep in mind that not all follow-through days work, and that's why you want to test the waters with smaller buys and not just dive right in. That said, there are a number of IBD 50 stocks that are setting up or have already moved into potential buy zones. Ellie Mae is approaching an 83.02 buy point, and note how its relative strength line has moved into new high ground. As we'll talk about later in the show, you want to see that 10-week line get back above the 40-week moving average to further confirm Ellie Mae's technical rebound. Edwards Life Sciences broke out this week and is still trading within an 83.53 to 87.71 buy zone. So be sure to check out the latest list of IBD 50 stocks in Monday's paper for more stocks that are forming bases. While many of the stocks reporting next week are technically damaged, see how they fare and what type of guidance they provide for the rest of the year. Notable tech names on deck include Fitbit, Mobileye, Palo Alto Networks, and Salesforce. And 2 top property REITs, Extra Space Storage and Store Capital, also report. We'll also see what the latest numbers from NetEase and Baidu say about the Chinese economy. Even the best stocks take a breather as they make a big run, and sometimes they really get hammered, but somehow manage to bounce back. So today we're going to look at one technical indicator that could mean that this beaten down stock may be on the verge of a rebound.
Now, what we're looking at is the 10-week and the 40-week lines. When a stock rises back above its 40-week line, that should capture your attention, especially if it keeps rising. Conversely, as a stock weakens or build a base, the 10-week line will fall beneath the 40-week.
Now, Apple is a good example of what we're talking about. During the 2008 bear market, the 10-week moving average fell below the 40-week line, and that's a clear sign of weakness. Then in May 2009, that reversed. Now, this was a couple of months into a new bull cycle, so the 10-week line getting back above the 40-week was one indicator that Apple was showing renewed strength.
Now remember the new bull market that had started in March on the 12th, 2009. It took a few months for the 10-week line to get back above the 40-week. Now confirmation that this stock was recovering with a number of weeks up in a row off of the bottom. And notice that the 10-week stayed above that 40-week line for several months until November 2012, and then the 10-week fell below the 40-week.
So that was part of another big sell-off in Apple. But then, around August 2013, look what happened. The 10-week line got back above the 40-week. Now, this is not a buy signal, but it is a sign that the stock may be on the mend and setting up another nice run.
Now, Apple was working on a very long 45-week cup with handle base, and it was rather deep. It was 45% deep. But the 10-week crossing above the 40 was the beginning of Apple looking much better as it formed that right side of the base and the handle area. And around April of 2014, those two lines came pretty close together before Apple stock really broke out again and began to make another nice move.
And from that breakout, Apple rose about 63% until peaking in April 2015. The 10-week line getting back above that 40-week line is not a guarantee that the stock is going to take off. But until that happens, it's more likely that the stock needs more time to regroup.
Now, a stock that exemplifies what Matt just said is Google, which was its name at the time, now known as Alphabet. And the 10-week tried to get back above the 40-week a couple of times before it really worked. Around October 2010, the 10-week line tried to get back above the 40-week, but before long, it rolled over and fell beneath that benchmark line again.
And that happened again in early November 2011. And the consolidation that Google was forming at the time was very sloppy. The stock tried to break out, but it came back down. And the 10-week line fell below the 40-week moving average again in June 2012. But then that reversed in August, and the new base that Google was forming, it looked better, and this time it worked.
And it traded in a tight range for several weeks in a row, which is always what you want to see. That means that the pros are supporting the stock at that price level. And the 10-week line stayed nicely above the 40-week line for 2 years. In early October 2014, the 10-week fell beneath the 40-week line as it was forming a base.
So tracking this relationship of the 10-week line to the 40-week line can also help you hold a winner. You can see here how Google found support at the 40-week line in October 2013 and how the 10-week line stayed above that 40-week benchmark. So that can help you sit tight.
Now, this is a current chart of Alphabet, and that 10-week line is curling. Just starting to curl a little bit, Matt, but it has not yet come down to the 40-week. But it is something to watch. Will Alphabet base again? Will it take off in a new uptrend, or will it continue to sell off? And then we get a new crop of winners.
Well, let's take a quick break and we'll see how you can apply this strategy to Facebook and Amazon.
How would you like an edge that helps you pick winning stocks faster? An edge that is proven to outperform the S&P 500 by 76% since inception, and that you can take advantage of today without spending a dime. More on that in a minute. Each day, our top market team at Investors Business Daily scans our proprietary stock lists and screens to find superior stocks with the most potential for big gains. They analyze these stocks every step of the way to show you basis, buy points, sell signals, and the right time to take profits. It's about as close to hold your hand investing as you can get. Introducing Leaderboard by Investors Business Daily. For a limited time, you can try all of the premium features Leaderboard has to offer for a full 14 days at absolutely no cost to you. You'll receive unlimited access to all of the time-saving research, powerful investing tools, the leaders list, cut list, and expert analysis you need to develop a winning investing strategy. And it's all 100% free for your first 14 days.
We're discussing whether a stock might be showing some strength or weakness using the 10 and the 40-week crossover. Now, Amazon is a good stock to analyze for the 10 and the 40-week crossover, so let's take a look at it. Back in May 2012, it was forming a handle portion of the cup-shaped base, and the 10-week line moved back above the 40-week. And as the stock moved higher and formed a series of bases, that 10-week line stayed above the 40 really nicely.
Right. So when you're looking at a big name, market-leading stock that is now sold off sharply, and you're wondering, is it getting ready to rebound? That is a key indicator to look for. It certainly does not guarantee success, as we saw with Google, but until that 10-week line gets back above the 40-week, odds are that the stock is not yet ready to make a big new run.
Now, the breakout occurred several weeks after that crossover, so you don't want to buy just because the stock crosses over. Conversely, when the 10-week line moves back below the 40-week line, it could be just because the stock is taking a breather or it's forming another base. And this is what happened with Amazon in April 2014 when the stock began correcting.
Now, of course, you don't need to wait for the 10-week line to get back below the 40-week line before taking some profits off the table. Now, when Amazon crashed below the 10-week moving average during the week ended January 31st, 2014, that was certainly a warning sign, especially since volume spiked. It came in 152% above average.
Now, in early February of last year, Amazon's 10-week broke above the 40-week line again as it was in a long price consolidation. And this happened as the company reported its earnings. It soared higher, we had heavy volume, and it held up very, very tight until it reported earnings again, and it broke out of the price consolidation.
So to reiterate, the 10-week line crossing over is not necessarily a buy signal, but it is a sign of renewed strength. And if that is followed by a proper breakout, as it was with Amazon, then it can be an opportunity to invest. Amazon made a very nice gain of about 78% from this breakout until peaking in December 2015.
Now, right now, the 10-week line is curling over, but it has not yet dropped below the 40-week line, but it is something to keep watching. Facebook is another stock to study. Now, going back to July 2013, the 10-week line crossed above the 40-week line, and remember, it was a newer IPO then. And this crossover happened because Facebook reported some real earnings numbers for the very first time. And notice the 10-week line just soared almost vertically. That's how powerful the move was.
Right, and since then, Facebook has formed multiple bases, and it's hit some long sideways patches. But note that the 10-week line has not yet fallen back below the 40-week moving average. So tracking those lines can help you hold leading stocks through multiple bases. Of course, that's once you have a nice profit cushion. And if you're wondering if a former leader like Apple or some other big name stock like that is going to bounce back or not, make sure that first the 10-week line gets back above the 40-week moving average. So before we wrap up, we want to remind you that there are notes for each episode on our website, as well as links to how you can download the show on iTunes. You'll find all of that at investors.com/investingshow.
Okay, see you next week, everybody.